Hello, everybody, and thanks for joining me on this video conference. I'm really sorry I can't be with you in person, obviously due to the COVID pandemic. Now, if you have any queries during the presentation, please feel free to drop any questions into the chat box. So I am James Cook. I'm the head of global equity at Ashburton Investments. Today, I'm going to be talking about COVID vaccines and more briefly about what they mean for global equity investing. So I lead our global equity team at Ashburton International. I'm based in Jersey, and I'm sure many of you know that Ashburton is the international investment manager of First Rand Group. Now, we and the team had a lot of ideas of different topics that you might be interested in hearing about today. And every single one of my colleagues thought that you would be interested in hearing from me talking about vaccines. Now, my colleagues don't often agree on very much, which is really good for healthy levels of debate. So why on earth did they all unanimously think that you would want to listen to a fund manager talk about vaccines? And the answer is that although I've always been passionate about investment, I haven't always been a fund manager. In fact, 17 years ago, I was considered an expert in the manufacture of DNA vaccines, genetic vaccines. So I obtained my PhD from the University College London. I was sponsored by the British Biological Research Council and also GlaxoSmithKline. And a bit unusually, I spent 3 years at my industrial sponsor's research site, where I had a whole batch of bioreactors to do experiments on. So the assumption from my team is that I will have something that should be of interest to you to talk about vaccines. And I'm going to really try my hardest not to use any technical language, but if I do, please feel free to ask about it. So in terms of an agenda, I thought we would mainly be talking about COVID vaccines. Then I'd like to spend a little time briefly on what we think drives equity markets, and then end on Ashburton's active global equity positioning. So in terms of vaccines, there were 3 areas that I thought were worth covering: need, speed, and greed. So for need, let's just quickly have a look at a picture of the COVID virus itself. This is a representation of the genetic code of the virus from the NCBI database, with every gene that it codes for. And the one I've ringed is the spike protein, and this is about 1/7 of the total amount of genetic code. And then I've shown where that sits, what that codes for on the right-hand side in this representation of the virus. There's the spike protein. And when you look at this picture of the virus, you realize it's really quite a simple structure. You've just got this messenger RNA in the middle and these spike proteins on the outside. This virus has used the host machinery in order to replicate. Now, this particular virus, unfortunately, is highly contagious, and sadly, the immune system reaction to it for some people has been deadly. So I think even though we are at an investment conference, we'd all agree that the primary need for vaccines is a humanitarian one. The COVID-19 pandemic has resulted in over 2.5 million deaths. And it's also becoming clearer that the virus has some lingering after effects for certain individuals, so-called long COVID. Also, the amount of COVID cases that there are, when we've got a large amount of cases, then it's more likely that we will see more variants develop. And these different variants could be more infective, could spread more easily, or also be more harmful. Efforts to contain the spread of the virus and to reduce stresses on health services have led to lockdown efforts, and this resulted in a large reduction in employment, which in turn potentially created a humanitarian crisis. Now, it seems a little crass here to talk about the economic impacts, but as you all know, these have been very significant. Some countries are likely to see economic scarring from the virus, while other countries are going to bounce back to trend levels of growth more rapidly. So just to think about scarring for a moment, this is where some countries will find it more difficult to return to long-run levels of growth of GDP. And I'm sure you can think of A variety of reasons for this. Two things you might think of might be the lack of education for a period of time of some of the young people, and also a lack of available financing. So governments and central banks have had to respond to this economic disaster, and you will be aware of the huge amount of stimulus efforts that there have been. One of my favorite measures of this is to realize that almost a quarter of United States dollars in issue were created just in the last year. This is pretty extraordinary. While these stimulus efforts and all the monetary policy responses have helped ease business conditions, there's no doubt that to resolve the underlying cause of the crisis, a vaccine needed to be developed. Now, a byproduct, of course, of all of these central bank actions has been inflated asset prices, and we will talk about that later on. So on to speed. Historically, it has taken between 10 and 15 years to develop a new vaccine from start to finish. So it is quite remarkable that the world now has no less than 5 successful Western vaccines. And I haven't included the Chinese and Russian developed vaccines for reasons you might like to think of yourself. Here's a graphic showing the normal timeline and the shortened one that was achieved by Oxford AstraZeneca, Pfizer-BioNTech, and Moderna, and also Johnson & Johnson and Novavax, who reported positive phase 3 trials in January. This is genuinely pretty amazing, though as I'll comment later on, the development speed does have some ramifications. So here are the main vaccine developers so far with successful products and what sort of technology they used and when this was first introduced. The oldest sort of technology is at the top. Inactivated viruses were first used for polio vaccines in the 1950s. And interestingly, the inventor of that vaccine, Dr. Salk, refused to patent this and gave it to the world. Essentially, you cook up a complete virus, inactivate it, and then give this whole but unable to replicate virus to people along with adjuvants that stimulate the immune system. This technology has been around for a long time. Novavax has used a protein subunit. While historically, vaccines using a protein subunit were made out of blood products from immune patients, for example, hepatitis B, Novavax is using recombinant technology, which I think was first used to treat Lyme's disease, vaccinate for Lyme's disease in the early 1990s. And I believe Novavax is actually using insect cells to manufacture their product. The protein purification techniques used thereafter will be pretty standard. Viral vectors have been used to make vaccines historically against Ebola and Zika. However, I think because of the amount of outbreaks that there were, I don't think that there was conclusive clinical trial data. However, once made, they are relatively straightforward to manufacture in large quantities. And finally, genetic vaccines. These two are both mRNA. As a reminder, my specialty was in DNA vaccine manufacture. Actually, the process to make these mRNA vaccines seems to involve both the microbial manufacturing step, making something akin to a DNA vaccine, followed by introducing this to mammalian cells and then extracting the mRNA produced in this way. In other words, it's really pretty complicated. And these are the very first products produced in this way. So why is technology age actually of any relevance? And it's because it's during the development part of research and development that biochemical engineers are typically involved to scale up manufacturing. Once products enter clinical trials and are then approved, there are strict protocols to be followed, and there are no changes made to manufacturing processes, because otherwise these would require further clinical trials. The FDA, the Food and Drug Administration in America, introduced really strict rules on not changing the manufacturing process following a sulfidamide tragedy back in the 1930s. So just to repeat, once a product's been approved, you cannot then change the manufacturing process. So because the preclinical, during the preclinical phase, you would normally expect to increase the amount of yield, optimize lots of manufacturing conditions, and do lots and lots of experiments to work out the best conditions for all of the unit nations, you're not going to be getting very high yields from very new products. And just to try and give an example of what biochemical engineers can add to a process, back in the 1940s, when you had a really new product in terms of penicillin, scientists at Merck managed to raise the yield of penicillin over 25,000%. So this was really a combined effort by lots of US pharmaceutical companies to work out how to scale manufacturing during the war effort on a not-for-profit basis. This made what would otherwise have been an incredibly difficult product to produce into something that was more readily available and affordable. Scaling up processes rapidly, particularly for new technology, is rarely going to achieve optimal conditions. And this means that the cost per dose is going to be high and manufacturing output is going to be low. So what does this mean for the products that we've seen, successful vaccine products that we've seen? Well, if we look now onto cost and price. So there've been multiple reports for different prices and supply agreements for the supply of vaccines to countries. And what we've plotted here is the average of the highest and the lowest reported prices, and tried then to show a decomposition of the price. Now, the two largest elements are the bottom and top part of the chart, cost of manufacturing and profit. So note that Oxford University and AstraZeneca are making their vaccine on a not-for-profit basis. Interestingly, Johnson & Johnson have also indicated their intention to do this. So I don't really understand why the average price per dose they're reporting is north of $10 when they ought to have similar manufacturing costs to AstraZeneca. Again, there are a lot of assumptions that are put into here. So as you can see, the cost of Moderna and Pfizer's vaccine, actually the manufacturing cost is very, very large in comparison to the other products, which are using technologies that have been around for a lot longer. And then there are other costs to consider too. Cold chain supply, and you may be aware that messenger RNA vaccines require very, very cold storage levels indeed. So I hope that goes some way to explaining the big differences between price and availability of vaccines. When I've said greed, I am talking about the profits that companies make, and the whole patent system is designed to try and reward innovation. And you know, I'm supposed to be a bit naughty talking about greed now. So on to vaccine and vaccinations. There were a few nations that managed to secure vaccines that they bought at risk before we even knew if the vaccines work. Notably Canada, the USA, and the United Kingdom. And these nations secured something like 7 to 9 potential vaccines per capita. So this work was done by Bloomberg towards the end of January. What's actually important is the timings of when some of these deals were struck, because that's important in some instances about which nations actually get the vaccines first. But it's not just the securing of the supply of vaccine, but the implementation of the rollouts that's very important. And by Q3 this year, it is expected that the rate limiting step to vaccination will be logistics rather than vaccine manufacturing. So this chart shows the amount of people who have had at least one dose of vaccine by different nations. And you can see that Israel and the United Arab Emirates really lead the way on this front. In terms of markets that are more investable, have lots of more of an interest to global equity funds, we're going to have a look at the rest of the world on the next chart. And here we can see the speed at which vaccination is occurring from the United Kingdom, the United States, and Chile. And you can see that the speed in the United Kingdom has been really very rapid. And this is speaks to the logistic capability in that country, and also their supply of vaccines. What's been really encouraging has been a recent paper by Public Health England on the efficacy of the mass vaccinations programs in the United Kingdom, where we've seen a significant reduction in the amount of hospitalizations. Now, of course, the fly in the ointment will be around the efficacy of these existing vaccines against new variants of the virus, and we can cover some of that in the Q&A session. But given the audience and likely interest, I think it's worth noting that the lead investigator of a small study of the AstraZeneca vaccine on the South African variant concluded that the AstraZeneca vaccine still had a high likelihood of preventing severe disease and death. And it's also worth mentioning that significant amounts of research efforts are going into tailoring vaccines, and regulators will be encouraging these minor changes to the spike protein sequence targeted in order to try and get vaccines that will work well for these other variants. And the trials of these other vaccines targeting these particular variants are expected to begin imminently. So we've covered the need, the greed, and the speed of vaccine development, and we've gone into a little bit of detail on the different types of vaccines, why they cost different amounts, why their availability is different given the ease of manufacturing, and also covered a bit about the unfair distribution of vaccines globally. So I'm sure some of you may be wondering why any of this is relevant to equity market returns and fund management. So equity markets, we think, are driven by these three factors. Money supply, I mentioned briefly before, but with interest rates incredibly low and aggressive quantitative easing and fiscal stimulus, we have seen substantial asset price inflation. Central bankers are unlikely to withdraw from this rapidly, and so we believe that they will want to prevent any so-called taper tantrums. Inflation is really the key here, and I'm sure that there will be other people talking about this all day at this conference, and it really is worthy of its own slot. Inflation has huge implications on any form of fixed income and multi-asset investing in particular, but also will impact the ability of central banks to maintain the current policies that they have. On to economic growth, the rollouts of successful vaccination programs are the biggest unknown in any economist's forecast for the coming couple of years, and also potentially in perpetuity, given that equities are very long duration assets. And then sentiment and valuation. We know that equity investors dislike uncertainty, and as things become more certain, they do tend to pay higher prices. On valuations, we're always looking for quality equities that we can buy that are cheaper than what we think that they're worth. So how are we taking these views on vaccines and then implementing them? So we have a couple of quite distinct global equity styles at Ashburton, and Global Leaders is focused on today's leading companies. We're looking for quality companies trading at a reasonable price. Now, the term quality is banded around a huge amount by fund managers, and often we don't hear from them what they really think that it means. So we think there are several elements. We look for strong balance sheets, generation of economic profit, that means making returns in excess of their cost of capital, and then it's really some reason to think that this level of profit generation is sustainable. We also like to see good levels of shareholder treatment. So that's the G in governance of the ESG, with environmental and sustainability looked at within our sustainability of business model. And we like to see steady and growing levels of earnings. And then our global equity growth strategy is really looking for tomorrow's leaders. So some of our style tilts, the way we structure our strategies, are to do with that. But we have some consistent themes. We've seen that the geographic rollouts of vaccines are quite different across different nations. And in both our global leaders strategy and our global equity growth strategy, for instance, we now really have quite high exposures to the United Kingdom. So money supply there looks to continue to be positive. We think that the UK economy is going to recover from COVID more rapidly due to many other parts of the world, due to the vaccination programme. We've heard very recently that the furlough programme will be extended. That's the government continuing to cover wages of people that have unfortunately not been able to work due to the pandemic. And also valuations in the UK are depressed relative to much of the rest of the world. with sentiment particularly weak. And that's partly also due to Brexit. And there was a lot of uncertainty about Brexit and the UK's ongoing relationship with the European Union. But there is no uncertainty anymore. The deal is done. So we think there's scope for sentiment to reverse here and see the return of international investors into the UK equity market. How are we playing this directly? Well, within global leaders, for instance, we fairly recently added a position to Lloyds Bank. Lloyds is a high quality retail bank. It generates net interest margins 2 or 3% above peers and has best in class cost to income ratios of below 60%. Now, shares really suffered last year, of course, due to COVID concerns, but also due to the UK regulator not permitting any bank to pay any dividend. However, the bank has a very strong balance sheet with core tier 1 ratio above 16%, and dividends have just been reintroduced. So the bank shares are yielding around 4%. And the UK government has really provided tremendous levels of support, as I mentioned, to the UK population. In the global equity growth strategy, we hold the FTSE 250, which is the 101st to the 350th largest listed equities on the main exchange. Now, this includes a large number of domestically focused businesses, and we think they're set to benefit from the economic recovery in the UK. We're also relatively overweight the energy sector. The incredible downturn in the oil market last year led to very depressed share prices. And though there's clearly a clean energy transition to happen, we think it's unlikely these firms ever trade back to their historic highs. Oil companies are very geared towards oil prices and are hugely cash generative. And there's a number of reasons to think that the oil price will be sustained at the relatively high levels it is now. Yield curve steepening, we've seen that being positive for financials, and I think that explains our overweight position there. And we've also reduced our exposure slightly to consumer staples and healthcare names. And this is broadly in line with the positioning of the firm's multi-asset range too. In terms of benefiting from fiscal spending plans, we have exposure to an aggregate name likely to benefit with a market-leading position. And also an industrials company we believe is set to benefit from increasing electrification efforts in the United States. So how is this turning out for us? So this slide shows the risk versus risk return for the two global equity strategies we're talking about. So risk, we're looking here at standard deviation on the x-axis, and this is an objective measure of risk. You can argue about if volatility is a good measure of risk or not, and then return on the y-axis. So you can see that both of these strategies have taken considerably less risk than the market, and over the last 3 years. And you can see that the global leaders strategy has delivered close to the index level of return, but with significantly less risk, with a more comfortable risk profile. And we'll have a look at the drawdown in a moment. Whereas the global equity growth strategy has again taken less risk than the market, but delivered superior returns. And the next slide shows the drawdown. So this is the amount of loss over any particular period of time of these two strategies on the global index. And you can see that in times when the market has fallen substantially, the portfolio, these two strategies have performed better than the market, fallen less, which means that our investors have had a more comfortable ride through a very difficult time. So to summarize again, we've had a whistle-stop tour through vaccines. We've covered some of the vaccine rollout, what the key drivers of the equity market are, and how Ashburton's active global equity funds are positioned. So if you'd like any more information, please drop us a line at Ashburton, and look forward to speaking to some of you in the future. Thank you for your time.